what exactly is a wholesale real estate contract?
A wholesale real estate contract at its core is a real estate purchase agreement, which allows a buyer to purchase a property from a property owner who would be called the seller. Once you have that formed, you want some specific terms in that purchase agreement, which would allow that buyer to then sell their interest to a different buyer. And the goal is to make a fee for transferring your rights to somebody else, which is really essentially what a wholesale is. And so the contract you want to use is not just a typical purchase agreement, although at its essence it is. You want to have certain terms that's going to protect you as the buyer / wholesaler and allow you to enter this agreement favorably so that everyone's protected and that you can actually execute this wholesale profitably and safely so that your money is not at risk. There can be multiple contracts involved depending on how you want to wholesale a property. So I think it's important to mention that wholesaling can mean different things to different people. There are multiple ways that you can wholesale a piece of real estate, right? Multiple ways you can wholesale houses. And depending on what strategy you want to use to wholesale, you're going to use different wholesale real estate contracts.
Right.
So, for example, there's the most common wholesale strategy is the assignment of contract method. There's also a double closing method, which uses a different set of contracts. And there's also an LLC assignment method as well, which is a completely different set of contracts as well. Of course, there's some overlap, but it's just important to understand what strategy are you using, and therefore you can get the right paperwork in place to execute on that strategy.
Right.
And
would it be kind of safe to say then, like, assignment of contract is the most like beginner friendly closing process out of all three of those that you just mentioned?
I would say that, yeah, the assignment of contract is generally what we teach our students first and foremost, because there's no closing costs involved to the wholesaler. And it's really just the most straightforward way to wholesale real estate. And it's very simple as far as the paperwork involved.
Okay. Yeah. It's pretty common then among beginners like me, hopefully, right?
Yeah, no, definitely. That's generally what we prescribe as far as if it's your first time wholesaling real estate, if you're just getting started in wholesaling houses, the assignment of contract method is absolutely the way that we would recommend doing it at first.
Right.
There is another method. It's using what we'd call an independent consultant agreement. And so, again, just trying to reinforce that there are many ways to do it. So a lot of people just categorize wholesaling in one bucket. But today we're going to really be focusing on some of the main strategies like the assignment of contract. Cool. And even we'll touch on double closing as well.
Yeah, because for me, haven't done it before, easier is better, simpler is better. So I'd love to kind of leave today kind of just having a good backing, a good like piece of confidence that I could actually tackle filling one of these out and hopefully making my first wholesale deal as well, you know?
Yeah, absolutely. We'll cover everything today from, how to fill out these contracts. We've designed this to be very wholesale friendly. And so we'll go through it later, line by line as much as you want to so that you can fill it out on your own. Our audience can absolutely fill it out on their own by the end of this. But more importantly, understand what it is, because I know it's very intimidating probably looking at this. It's just a bunch of legal jargon at the end of the day. But what this is and what I want you to really emphasize in your mind, this mind shift is your mindset shift is that this is a money-making tool.
Right.
These sheets of paper can make, $5, $10, $20, $50,000, maybe even over six figures in profit per deal if you structure it and you know how to work these pieces of paper the right way. So wholesaling is all about the contracts. And so the more you understand about these pieces of paper, the more empowered you're going to be to successfully close deals.
You can see why it scared me a little bit.
Yeah, of course.
Well, here we go. Let's get right into it. So you mentioned signing the contract is the closing process, the most common, most beginner friendly. On a high level, can you just kind of walk me through that process step by step?
Absolutely. So again, it all starts with the real estate purchase and sale agreement. So there's other names for it. Purchase and sale agreement is abbreviated PSA. There's a lot of different names. You might hear offer contract, purchase contract. these are all interchangeable in the real estate world. So you might hear different names, especially if you're in other states, different markets. There's going to be specific names, especially for the realtor approved contracts, that are going to sound different in depending on what location you're in. The contract we'll review today is a more standard agreement that we've used in multiple states across the country. It's a real general contract to use, and it's called the Real Estate Purchase and Sale Agreement. So what that does is that is a legally binding agreement between a buyer and a property owner, which memorializes the agreement to sell the property. And it will discuss different terms, such as the parties involved, right? The buyer and the seller, the terms of the agreement. The main terms of that agreement is the purchase price, the earnest money deposit amount, the timelines involved, right? How quickly you're going to be closing on the sale of the property. Obviously, you want to name the property at question, so the address, the assessor's parcel number. So really just the details of the property itself. And then the terms of the sale. So are you paying cash? Is this a subject to transaction? Is this seller financed? Are you getting a loan, traditional loan? So generally with wholesale transactions, you're going to be offering cash. And that's how we're able to provide distressed sellers with the speed and convenience of knowing that they're going to be closing and receiving cash to their bank account. So generally wholesalers are offering cash or a cash equivalent when they're buying these pieces of real estate. Oftentimes these houses that we're buying below market value do not even qualify for conventional financing, right? First time home buyer loans, traditional Fannie Freddie type of financing. These properties are in such distressed shape that they are really meant for a cash offer. So So without going too much in the weeds, first you have the purchase and sale agreement, which now once you have the buyer's signature and the seller's signature on, that is really a meeting of the mind saying, me as the buyer, I'm willing to buy this property, and the seller agrees to sell it to me under the terms of the agreement. Now, what happens when you wholesale the property is that if you are the wholesaler as the buyer, you're now finding a different buyer to replace yourself on the contract.
Right.
So that another buyer who might be an investor looking to add another deal to their portfolio of rentals or looking to buy, fix, and sell a property for a nice profit, right? The classic fix and flip.
Yeah.
You want to partner with other investors who you can now assign the contract to, which means you're now transferring your rights to buy this property to somebody else. And that individual or company can now purchase this property under the same terms of that purchase and sale agreement. So what the assignment agreement does, it's an agreement that is between you and the next buyer, right? We call them an end buyer, a cash buyer. So someone else who's going to be replacing yourself on that contract, and everything else on that agreement stays the same. So what the assignment agreement does is it's executed after the purchase and sale agreement. So once you're under contract with the seller, you've secured the right to buy that property. You're now using an assignment contract to effectively transfer your rights to somebody else who can now slide in and close on that deal and give the seller what your original purchase price is. But then on the assignment contracts, you can now add an assignment fee on top of it. So they can pay you an assignment fee for the rights to buy that property.
Got it. Okay. So let me try to review it. Correct me if I'm wrong, which I will be. Are you ready for this? Okay. So the purchase and sale agreement basically just says I now have the rights to purchase this house. The seller is like, yeah, that's cool. You have the rights to buy my house. I'm not actually buying it. I'm going to wholesale it to another cash buyer. And that's what this is for, the assignment addendum. I'm basically saying I'm not actually buying it. This guy is. And then everything is good after that. I've wholesaled the property, hopefully, if all of this is right. And then the fee I get is stated in the assignment addendum.
Correct. So with a purchase agreement, so when you enter into a purchase agreement, you are the buyer on the contract. Now, so the purchase agreement states that you, Tim, are buying this piece of real estate. Okay. So you are now the actual buyer on that contract. So until you assign the contract, you are the buyer. You're saying, hey, I'm buying this property.
Got it.
Under the conditions of this contract. Now, there are ways to get out of that contract, which we always want to have present in the contract, which we can agree in a bit. But until you assign the contract, you're technically the buyer, and you're saying, hey, seller, I am buying your property. So it is a legally binding agreement to some extent. And once you assign it, now you're technically not a party to the transaction anymore. You are considered the assignor, and the buyer is the assignee, meaning they have received the assignment of the purchase agreement, and they can slide in and now close that deal with the seller. They are now the buyer. So you're essentially removing yourself as the buyer, and you're in many cases completely off the hook for whatever happens in that purchase agreement, because there's a new buyer who assumes all of the responsibility, the financial burden, the potential consequences of not performing that contract. So if you structure it the right way, like we have in these contracts, you will now be able to remove yourself from the deal and carve out a fee for assigning the contract to a different buyer.
Got it. So that's where I was kind of confused. It's like, okay, am the buyer in this sense, and everything's being transferred through this thing.
Yeah, exactly. So even though you might have an intention of wholesaling the property, in order to truly control the deal and actually secure an interest in being able to wholesale the property, you need to become the buyer.
Got it.
So we always encourage our students and people that we work with to really take the position that they are real estate investors, because really like nearly everyone we work with, they essentially want to become property owners. And, part of real estate investing is sending offers, it's analyzing deals, it's sometimes wholesaling as well. And so if you really take the position of, hey, I'm a real estate investor, I'm buying these properties, then, you can really own the fact that you are making these offers to purchase.
Right.
So you do truly have that intent.
Got it.
Because otherwise, then it's kind of a flimsy contract if you're not really able to perform on it, right? You want to be that buyer, and ultimately, you may want to wholesale it, which is where the assignment comes in. And when you're double closing it, which we can talk about, you actually are buying it. You're just immediately reselling it. So
okay, yeah. Can you highlight double closing then? Because I'm sure I'll come up, in that situation probably more than likely, right? At some point in my wholesale career. So assigning is just these pieces of paper, buyer, wholesaler, seller. So double closing. Can you kind of highlight that process?
Yeah, absolutely. So it's double closing is a different type of wholesale where you essentially you sign the same real estate purchase and sale agreement, but then you actually sign another one with your end buyer. So instead of assigning that original purchase agreement to a different buyer, you're now signing a second purchase and sale agreement with you as the seller and your end buyer as the buyer on that agreement. So now have
two of these,
yes.
two of the purchase agreements.
So you now have two purchase agreements. There's no assignment contracts involved. And so on the first one, they call it the AB contract in kind of the wholesale realm. The AB contract is between you and the seller. And then the BC contract is between you and the end buyer, right? So you're the seller. And there are some terms you're going to want to include in both contracts to make sure that the timelines are lining up correctly so that you're closing on the same day, and you can ultimately line them up perfectly so where you don't have any risk involved as far as your earnest money deposits and your contingencies. So there's ways that we advise people how to structure both contracts to ensure that you don't have any risk in the deal.
Got it. A little bit of clarification on double closing then. Am I using my money to buy the property then and then selling it again? Or is it the same kind of wholesale process where it's like none of my money technically is being used at all? Like that's kind of a little bit confusing for me. So yeah.
No, great question. So there are ways to do it without any of your own money.
Yeah.
We recently closed a few deals actually that we didn't put up $1 of our own money to close the deals, even with the double closing. So there's ways to do it where you can use the end buyer's funds to completely fund the whole deal. And you don't even have to take out a loan or transactional lending. You don't have to take out a hard money loan or use any of your own cash. So there are absolutely ways that you can double close a property without any of your own money.
Right.
And again, I don't know if I touched on this, but you actually are closing on the property and then immediately reselling it.
Yeah.
Sometimes moments later, really on the same day is typically how you want to structure it. So you'll actually show up on title as the owner, and within the same day, you're now the seller of that same property, and your end buyer is now going to be on the title.
Got it. So like, because it's such a it should be like a quick process of that transfer. Technically, you do have the funds because it's technically just their funds, right? So I bought it, but like, hours later, he buys it from me. So the money's still getting to that original seller just as fast, pretty much, because we're kind of working together.
Yeah,
right?
exactly. Right. So you would basically line up the two closings. So there's literally two closings that happen.
Right.
The first closing is the original purchase contract, and the second closing is between you and your cash buyer. And so if you structure it the right way, then your cash buyer's funds will go to the title company, and then they will actually use that money to close the first transaction. And so whatever the difference is your profit.
Right.
So if you have the first purchase agreement for $350,000 to buy a piece of real estate, and your second purchase agreement is for $400,000 to sell it to your cash buyer, they're going to fund $400,000 to the title company, and plus closing costs, and then you will then be able to take that money. The title company will use that money to then fund the first transaction, pay the original seller their $350,000 plus closing costs, and then whatever is the difference is your profit. So then they will send you a wire or a check for the difference, which is $50,000 minus closing costs. So that's essentially double closing. You're receiving a profit from the difference of the two sales prices. With the assignment of contract method, you're earning a fee. You're earning an assignment fee, and you're never actually on the transaction as far as on the title, because you never become the owner of the property in an assignment of contract deal.
Right. So in terms of like, let's just cover like assignment of contract versus like double closing, right? So in a double closing, you would never really need this thing then, realistically.
Correct.
Because you're not assigning it to anybody. You're buying it and reselling it immediately. Okay,
There'd be two purchase agreements with a double closing.
Got it.
So that's where the name double closing comes from.
Yeah.
Because you're actually, it's basically flipping a property.
Yeah.
Right? They call it wholesaling, where you're actually flipping the property, but you're closing on it and then just immediately reselling it the same day. So you don't really own it for any extended period of time.
Right.
Might be the next day where you're selling it, but usually it's on the same day.
What kind of situations would you say that might be what you have to do? Because it seems like a slightly more complicated. I know it probably to you isn't, but to me it's like, oh my gosh, like buy, sell, like double close. So like, what kind of situations do you think that I should look out for where a double closing would have to be like a essential thing to do? So
the most common reason you want to double close is that you don't want to disclose your assignment fee to your end buyer. So if you scored a great deal and you can realistically charge your end buyer a $50,000 wholesale fee or even a $100,000 wholesale fee, which I've seen before, then they might push back and say, hey, I don't want to pay you that much money. Like, that's a lot. And so with a double closing, they're only seeing the purchase price that you're presenting to them.
Right.
Whereas with an assignment contract, they'll see your assignment fee when they sign that assignment contract. So it reduces friction, and it just kind of it disguises your profit in the deal.
Right. Why wouldn't you always double close then?
There are some differences because typically you're paying closing costs. So there's two sets of closing costs because there's two transactions. So the benefit of assignment contracts is that you are getting the full amount of your assignment fee because that's just paid to you directly without any closing costs factored in. When you assign that purchase agreement to a different buyer, they're paying those closing costs because they're now the buyer. And a lot of times investors offer to pay all of the closing costs for sellers. And so that might not always be the case, but generally there are going to be some closing costs. So when you do double close, you're both the buyer and the seller, so there's going to be some transfer taxes, there's going to be some title fees, escrow fees, recording fees, notaries, things like that involved, which will then chip away at your profit. So,
got it. Okay.
So that's why if you're going to double close, you're generally going to want to have a bigger profit, 20,000, 30,000 or more, to really make up for some of the fees that you're going to incur.
I see. Okay. Yeah. So you kind of want to gauge, okay, I'm going to get like, let's just say a really large wholesale fee if I double close, but I have to make sure that the fees involved like kind of outweigh if I would have just done this, kind of a thing. So if my wholesale fee ends up being smaller, say like 10 grand or 5 grand, it's like kind of better to do this kind of a thing. So if my wholesale fee ends up being smaller, say like 10 grand or 5 grand, it's like kind of better to do this just so you're not hit with all these fees,
Absolutely.
Yeah.
That's like really the main reason. Other reasons also is if you have a purchase and sale agreement that is explicitly states that you cannot assign the contract. Maybe the seller, when you enter the contract, says, hey, there's no assignments involved. Sometimes you might be dealing with a bank that is particularly strict about assignments. Those situations, contracts are generally assignable unless they state in the contract that you cannot assign it.
Got it.
And even when they state that you can't assign it, you can always amend it later. So there, I think that's a little bit of a misconception that, hey, my contract is not assignable, so I can't assign the contract. You can always amend it. However, there may be a situation where you just can't assign it, or you just don't want to assign it for one reason or another. Then you can just simply double close, and now you're not having to assign that contract.
Got it.
So that's the second reason. The third reason, which I've actually run into, is that if you're wholesaling a property, wholesaling a house in a different state, sometimes when you buy and sell a property, that state may impose a tax withholding from the proceeds of the sale. So this is getting a little bit in the weeds with it, but we recently bought and sold a property in Colorado, and we're in California. I never saw the property, I've never even been to Denver.
Yeah.
So we bought and sold the property. We did a double closing, or we were planning to do a double closing, and title let me know that, hey, we're actually going to withhold 2% of the sales price from your net proceeds. So on a $460,000 sale, so when we sold it to the cash buyer, they were going to withhold 2%, which I think was like $9,000 or $10,000.
A lot, yeah.
So we were like, we don't want that to happen. So let's just structure it as an assignment. So we ended up doing it.
Oh, okay.
And so that way we didn't have any tax withholding. So, a little bit in the weeds, but that is something to look into. If you're virtually wholesaling, if you're wholesaling at a distance in other states, it's good to talk to title companies to ask, hey, are there any tax withholdings for foreign entities? So our company was a California company. We're doing business in Colorado, or some other states have this too, and they will actually withhold some of the proceeds of the sale, and they'll basically hold that money hostage for a year or so until you file taxes, and then they'll give you a refund later based on what you actually owe in taxes. So it's just, they'll just take your money and hold it to make sure you file your taxes in that state, so they get their tax revenue.
How common would you say that is?
I only saw it in this state, I'd be.
And you've been wholesaling for years now, so
it's So with regards to the double closing, it'll only happen in that situation where you're selling a property in a wholesale scenario. So I've done most of my wholesales as assignments or using a independent consultant agreement and just invoicing the buyer directly and getting paid directly. So those situations, it's just like you're earning income. Whereas when you're buying and selling a property in a short period of time, that's considered capital gains.
Right.
So there's a whole tax complication when you're buying and selling a piece of real estate. You're actually your revenue, your income on your tax return is actually the entire price of the property, and your cost of goods sold is what you paid for that property. So there's a whole different tax philosophy and how you're going to actually report that on your tax returns when you're double closing. Right. So when you're earning assignment fees, it's a lot more simple because you're just like, hey, I earned 20K here, 5K here.
Whereas this, it's like you're dealing with hundreds of thousands of dollars.
Exactly. Yeah. You'll look at your tax return and say, I made millions in gross revenue, but then you have all these costs of goods sold. So it's
I mean, it's good that you're teaching me kind of both avenues because like there's always like a plan B now. Technically,
absolutely.
And so you mentioned a third option though, and just to be super thorough, can you kind of cover? I think it was LLCs or
yes,
okay,
absolutely. So in this scenario, let's say you put a property under contract using the same purchase and sale agreement, and you either put it under contract under your LLC. We say, hey, Tim Home Buyers LLC is the buyer on the purchase agreement. You can now, instead of assigning the contract, instead of double closing, you are now assigning your LLC to a buyer for a fee. So you might sell your LLC for $20,000 to the end buyer. And this way, the buyer never changes on the contract and you're not assigning any contracts. You're just selling your LLC. And one of the assets of that LLC is the purchase agreement. Okay. So this is a purchase agreement, which is considered, an asset of whoever is the buyer on that contract. So you can simply assign your LLC. The membership interests of your LLC can be sold to the buyer instead. So this completely goes around any local wholesaling laws about assigning contracts or dealing with contracts, assignments. And so you're now not even marketing or selling the contract, you're marketing and selling your LLC.
Yeah.
And so to my knowledge, there's no state wholesaling laws, whether you're in Illinois or South Carolina, like there's no laws that prohibit you from selling an LLC or marketing or advertising an LLC. So if you structure it that way, you're now just selling your LLC for a fee. Yeah. And so the new buyer can take over your LLC and they can either close on that property under the same terms and price as the purchase agreement, or they can reassign that contract to their own LLC and close in their LLC. So it gives them options, but ultimately that's one way you can structure it through an LLC assignment. And, we work with some attorneys that even if you have it under your personal name, because you can still wholesale under your name as an individual, even if you don't yet have an LLC. And while you're under contract, you can work with an attorney to form an LLC specifically for this purpose. They call it a single purpose entity. And they'll form the LLC within 24 or 48 hours.
I was about to ask how long that takes.
Very quickly. It might cost $300, just the state filing fees and maybe a nominal fee to the attorney. Yeah. And then you can assign it to yourself, which there's really never any issues assigning a contract to yourself, even if the contract doesn't allow assignments because it's yourself. It's a wholly owned entity by Tim.
Right.
So why wouldn't they say yes to that, right? It's you at the end of the day and you can prove it.
Yeah.
So once you assign it to that LLC, you can now have a different agreement with your end buyer that basically is selling that LLC. And that buyer should be pretty confident because you just formed the LLC. It's completely clean. You don't even really need an EIN, right? An employer identification number, like a tax ID. You don't even need a bank account for that entity. It's just very clean. It's just a shell that you're now assigning to a new buyer. So that's the third strategy. It's less common. But it's a great tool to have in your arsenal.